Imagine a sports franchise, right, that drafts literally the greatest all-stars in history. You've got Google at point guard, Boeing at center.
IBM playing forward.
Yeah, exactly. IBM playing forward. They hit the court. They shatter every single performance record on the books. Their stats are completely off the charts. But somehow
they are losing the season.
They're losing. That exact paradox is happening right now, like today with Hedera.
Yeah, it's the absolute definition of a structural disconnect between fundamental utility and market valuation.
It really is. And, welcome to today's deep dive. If you are a new investor trying to navigate the crypto space right now, here in late June 2026, you are likely caught in this massive tug of war.
Oh, absolutely. It's tough out there.
Right. On one side, you have the temptation to chase speculative market trends, the overnight promises, the meme coin hype cycle.
The loud stuff.
The loud stuff, yeah. And on the other side, you want to invest in actual utility-based growth. You want to compare the noise against real networks doing real things. So today's mission is entirely focused on you and that exact dilemma.
Right.
We are unpacking the Hedera paradox. Why is a network with top-tier Fortune 500 adoption just, bleeding sideways in the market? And will its slow-burn, enterprise-grade utility ever actually pay off for the everyday investor?
To figure this out, we've pulled together a really substantial stack of sources for you. We're analyzing the latest crypto market reports from KuCoin and Coinpedia.
Really good data in those, by the way.
Yeah, fantastic data. We're also tearing into the official Canary Capital ETF prospectuses and pulling some deep ecosystem recaps from the Bitcoin Foundation. So we are looking strictly at the hard data to see what is actually happening under the hood.
Okay, let's unpack this, because before we can even touch why the price of Hedera's native token HBAR is struggling, we need to establish the architecture here.
Right, the foundation.
Yeah, because what trips a lot of people up is that Hedera isn't actually a blockchain. They completely abandoned the traditional sequential block bottleneck.
Which is a massive paradigm shift.
Totally. They use a directed acyclic graph, a DAG. So instead of batching blocks, nodes are constantly gossiping with each other. By bypassing the mempool congestion we see on layer ones like Ethereum, they're billing off a wild 10,000 transactions per second.
And that gossip about gossip protocol is what fundamentally separates their capability from the rest of the market.
How so? Like in practical terms?
Well, when you have a traditional blockchain, you constantly battle latency, right?
Yeah.
And network fees spike wildly during high traffic. A DAG structure provides completely different thermodynamic profile, so to speak. The information spreads exponentially fast.
Right.
You get finality in 3 to 5 seconds, consistently, without the network choking when usage spikes.
Okay, but speed is just the technical layer, right?
Yeah.
The governance model is where things get, heavily debated. They aren't relying on anonymous miners or random retail stakers to secure the network.
No, not at all.
It's governed by a council of 31 to 39 term-limited global corporations. We are talking about Google, IBM, Boeing, FedEx, NVIDIA, McLaren Racing.
It's quite the roster.
It is. And they each run a network node and have equal voting rights.
Which is an explicitly enterprise-first design. They built a decentralized governance structure, yes, but they anchored it with legally accountable multinational enterprises rather than, pseudonymous actors.
Which makes sense for corporations, I guess.
It does, because when a major financial institution looks at deploying on a public ledger, they need to know who is running the infrastructure. Having a known, legally compliant council provides this massive de-risking factor for enterprise adoption.
And it's clearly working on the adoption front. I mean, the network has processed over 71 billion total transactions.
71 billion.
They've settled over $10 billion in real-world assets. But, okay, here is where the paradox hits. And I have to push back on this narrative of success.
Fair enough. Go ahead.
If they have all this traction, right? If Google and Boeing are steering the ship, why is the HBI token stuck under 10 cents? Yeah. We're looking at a token down over 80% from its 2021 all-time high of 57 cents.
Yeah, that's the big question.
How does a network process 71 billion transactions and still just bleed sideways for years?
It's a completely valid frustration for anyone looking at the charts.
Yeah.
But to understand the price action, we have to detach from the speculative metrics that drive like 90% of crypto.
Okay. Detach how?
The reason this corporate all-star team isn't moving the needle for retail investors overnight lies in the fundamental design of HBAR's tokenomics. Hedera's economic model prioritizes corporate utility over retail speculation.
I want to look closely at that dynamic because, honestly, it feels like a raw deal for the everyday investor.
I can see why you'd say that.
Yeah. I mean, on Ethereum, transaction fees are partially burned, mathematically benefiting every single ETH holder. On Solana, the network provides staking yields, directly rewarding retail investors for locking up their liquidity. But Hedera completely rejects that model. Network fees are predictably pegged to the US dollar, but they're paid in HBAR, and those fees go directly to the council node operators and the Hedera treasury.
That is the core difference. They operate on a strictly demand-based model rather than a yield-based model. What's fascinating here...
Wait, I have to challenge that model, though. If a massive enterprise, say Tata Communications, is pumping millions of transactions through the network, and I'm an everyday investor holding HBAR, I get zero direct cut of that revenue pie.
Correct. You don't get a yield from that.
So you're essentially telling the retail investor they are second-class citizens to these mega corporations. Why would a new investor put their capital here when they could get a 5% to 7% yield literally anywhere else?
Because what's fascinating here is that lack of variable retail yield is the exact mechanism that enables the enterprise adoption in the first place.
How does that work?
Think about it from the perspective of a Fortune 500 chief financial officer. If you are going to migrate your global supply chain logistics onto a public ledger, you cannot have your operational costs spiking by 1,000% overnight just because a new meme coin is congesting the network.
Right, like we see on other chains.
Exactly. That lack of budget predictability is exactly why major corporations abandon traditional blockchains after pilot phases. They need fixed, predictable costs.
Okay, so it's essentially like investing in the concrete used to build a massive global toll road, rather than investing in the flashy sports cars driving on it.
That is a phenomenal way to look at it, yes.
It's not glamorous, it doesn't pay a daily dividend, but every single enterprise vehicle needs to buy that concrete to get from point A to point B.
Spot on. Hedera's fees are pegged to fractions of a US cent. That perfectly predictable low-cost fee structure is the ultimate selling point for an enterprise CFO. It deliberately alienates the speculative day trader crowd looking for fast burns and high yields.
In exchange for what, though?
In exchange for capturing the actual institutional volume. The token's value is designed to appreciate solely through massive, sustained enterprise demand companies, constantly needing to buy HBAR off the open market to fuel their billions of transactions.
Which means, if we are going to evaluate HBAR's utility-based growth against the broader speculative market trends for you, the listener, we have to look really closely at whether that corporate demand is actually scaling. We have to see if this concrete is actually being poured.
And the data from our sources indicates that it is, and the scale is somewhat unprecedented when you look at the specific use cases.
Like what? What's the standout?
Let's look at the European Union's Digital Product Passport, or DPP, regulations.
Oh, right. This is a massive compliance shift. The EU is legally requiring companies to prove the origin, sustainability, and lifecycle data of their physical products.
Right. And to comply with that, we are seeing major integrations, like the Merck track trace pilot.
The pharmaceutical giant.
Exactly. Merck is using Hedera for anti-counterfeiting. But let's look at the mechanics of why they chose Hedera for this. When you are tracking life-saving medication across borders, you are dealing with immense amounts of proprietary data.
Right. You can't just leak that.
Exactly. You can't just dump all that sensitive corporate data onto a public blockchain for your competitors to see.
So they use the DAG to process cryptographic hashes of the data rather than the raw data itself.
Yes. The hashgraph consensus allows them to log millions of encrypted hashes at a fraction of a cent per transaction. It proves the authenticity and timeline of the medicine without exposing the underlying trade secrets.
That's huge.
It is. Every product verification, every authenticity check across the European continent generates recurring network usage.
But, budget predictability and high throughput aren't just supply chain requirements. If we look at the financial sector, the requirements are even stricter. Our sources highlight Project Acacia.
Ah, yes, Project Acacia.
This wasn't some startup testing a new DeFi protocol. The Reserve Bank of Australia, literally a G20 central bank, ran a live, real money pilot program for tokenized assets and cross-institution settlement using Hedera's infrastructure.
And if we connect this to the bigger picture, the reason a central bank looks at a DAG rather than a traditional blockchain comes down to a really critical concept, cryptographic fairness.
Okay, unpack that for us.
On a traditional blockchain, miners or validators can reorder transactions in a block to extract value, what we call MEV, or maximal extractable value.
Right, they can front-run trades to make a profit.
Exactly. They can front-run trades. If you are a central bank settling national cross-border payments, you absolutely cannot allow validators to front-run your national currency settlements.
The order of operations has to be mathematically absolute.
Precisely. Hedera's consensus mechanism provides fair transaction ordering by default. The timestamp of when a transaction hits the network is mathematically proven by the Gossip protocol, making it incredibly difficult for any single node to manipulate the order for profit.
Wow.
Yeah. When central banks are testing your network for national financial settlements because your architecture prevents front-running, you have moved entirely out of the realm of retail crypto speculation.
And we're seeing this exact same demand for immutable logging in the AI sector right now, too. The AI Agent Lab launched on Hedera in March 2026, integrating with NVIDIA hardware to provide verifiable data provenance for autonomous AI systems.
This might be the most critical use case of all, frankly. Autonomous AI agents are currently making thousands of micro decisions a minute.
Right.
But the biggest vulnerability with AI right now is the hallucination effect, or relying on poisoned data sets. Enterprises need a tamper-proof audit trail of exactly what data the AI ingested and what logical steps it took to reach a decision.
And doing that on a traditional network would just bankrupt a company. I mean, if an AI agent is making 500 micro decisions a minute and each log costs even 50 cents in gas fees, the operational cost is completely unviable.
Unviable, yeah.
But on Hedera, those 500 micro decisions can be logged for pennies.
It creates incredibly sticky, recurring network traffic. Tracking medicine, verifying AI data streams, settling central bank transactions. These operations operate completely independently of crypto market fear and greed.
That's a great point.
Yeah, a hospital verifying a drug's authenticity or an AI logging its data pulls doesn't pause just because, a macroeconomic report caused Bitcoin to dip 5%.
Right, the utility is constant. But for these massive entities to keep using this infrastructure, they need more than just superior technology. A G20 central bank or a pharmaceutical giant requires absolute, bulletproof legal certainty. Which brings us to Hedera's regulatory moat.
This is where their slow, methodical corporate approach is creating a significant wedge between them and the rest of the market. In March of 2026, the SEC and the CFTC jointly classified HBAR as a digital commodity.
A digital commodity, not a security.
Right.
In the current regulatory climate, that is a massive legal dark cloud completely removed from the project. It removes the existential threat that hangs over so many other utility tokens.
It serves as the ultimate green light for institutional capital. And look, regardless of where anyone stands on the political spectrum regarding the current administration.
Right, we're just looking at the facts here.
Exactly. Strictly objective market analysis. Having the White House crypto policy chief speak at HederaCon 2026 is a massive signal. It indicates a level of high-tier government engagement and validation that meme coins and yield farming protocols simply do not have access to.
Here's where it gets really interesting, though. With all this institutional safety, the digital commodity status, the government engagement, we are seeing traditional Wall Street money aggressively move in.
Cold big time.
Canary Capital launched a spot HBAR ETF on the NASDAQ under the ticker HBR. The prospectus details are fascinating. It absorbed $93 million right out of the gate, which is about 1.3% of the total circulating supply, and there are 15 more ETFs currently pending approval.
The ETF dynamic fundamentally alters the market structure for HBR.
But I have to play devil's advocate here.
Sure, go for it.
If 15 ETFs are pending, won't billions of dollars flowing into these funds eventually trigger the exact same speculative hype and volatility that Hedera's entire model claims to avoid? Doesn't Wall Street speculation just replace retail speculation? Are they basically becoming the boomer stock of the crypto world?
It's a vital question. They kind of are becoming a boomer stock, but the mechanics of an ETF actually serve to dampen volatility over time rather than accelerate it like retail spot trading does.
How does that work?
Analysts refer to this as establishing a soft floor. When pension funds, family offices, and traditional asset managers buy into the Canary Capital ETF, the underlying HBAR is purchased and moved into cold storage by authorized participants.
Ah, so it's pulled out of the circulating supply completely.
Right, and institutional asset managers operate on quarterly or annual rebalancing schedules. They aren't panic selling on a Tuesday because of a rumor on Reddit.
That makes a lot of sense.
As these ETFs absorb more of the circulating supply, they replace volatile, highly emotional retail day traders with stable, long-term institutional holders. It mathematically reduces the wild downward swings of the asset.
And timing-wise, this is happening just as the European Union's MiCA regulations, the Markets in Crypto Assets framework, fully enforces on July 1st, 2026.
The MiCA enforcement is going to be a massive filter for the industry. Market analysts project that a significant percentage of crypto exchanges and decentralized projects will struggle to meet the strict auditing and governance requirements, and they could be forced to geo-block European users entirely.
Wow.
Yeah. A compliance-heavy, legally accountable, council-governed network like Hedera is perfectly positioned to absorb that displaced enterprise market share.
So what does this all mean for you, the investor listening right now? Let's bring this all together and compare this utility-based growth against the broader market. Based on the hard data from our sources, the price prediction models for HBAR in 2026 sit in a base case range of about 10 cents to 25 cents.
Right.
But if you are looking further out, projecting enterprise adoption into 2030, the models project a range from 35 cents up to $1.10.
Which heavily underscores the thesis of our analysis. If you are a new investor expecting HBAR to be a speculative asset that goes parabolic and prints life-changing wealth in a matter of weeks, the data emphatically suggest you are looking at the wrong ecosystem.
Our sources make it abundantly clear. HBAR is a moderate to high risk 3 to 5 year play. It requires immense patience.
Definitely.
You are waiting for this massive global enterprise plumbing to actually scale up. You are waiting for the billions of supply chain hashes and AI data logs to generate enough consistent network fees to drive the token's value on the open market.
The real takeaway here forces a hard look at your personal investment philosophy. Hedera represents the ultimate stress test for a crypto investor. Are you actually investing in the promise of fundamental, utility-driven technological growth?
Or are you, deep down, just looking to ride speculative, hype-driven market trends?
Exactly. Hedera has chosen its path entirely. They're completely ignoring the retail noise to build the back-end infrastructure for the Fortune 500.
They've poured the concrete for the toll road, and now we wait to see how much global traffic actually drives over it. You know, it brings to mind a concept from Hedera's CEO, Mance Harmon. He talks about achieving invisible ubiquity.
I love that phrase.
It's great, right? And it's a fascinating thought to leave you with today as you evaluate your own portfolio.
It really challenges the entire premise of how we currently value these networks. We are so used to judging a project by its social media metrics and influencer backing.
We absolutely are. But think about it. What if the ultimate winner of the global crypto race isn't the coin with the loudest community or the highest staking yields or the most aggressive marketing campaigns?
Right.
What if the real winner is the invisible network processing your airline ticket, verifying the authenticity of your prescription medicine, and securing the data streams for your autonomous AI without you ever even knowing its name?